Hello everybody, this is Joe Fahmy with a video on relative strength. I'm posting this video for two reasons. One, I think it's a great educational resource when the market's going through a correction as a way to find some of the stocks that are holding up well, that have the potential to become big winners. It's sort of one of my bread and butter strategies during corrections. I'm looking for growth stocks specifically that are holding up well when the market is weak. The second reason I'm posting this is I started a new educational product, and some people have asked me if there are any free trials. I do not offer any free trials. However, this video is it's a brief version of an actual video that can be found in my product. So I just wanted to give you guys a feel for the type of content you can expect in my new product. Now, if you have any questions, you can email me, jfahmy@zorcapital.com, or if you are interested in the product, you can visit the educational portion of my website at jofahmy.com. So let's jump right in with a simple definition. Relative strength, I'm looking for stocks showing strength relative to the market. In other words, the market's going through a correction. I'm just looking for stocks that are holding up well. This isn't a video on RSI in case you were thinking this was about the RSI indicator. I don't use that indicator. If you do, great. This is just, I'm trying to keep this simple for the viewers. Again, stocks showing strength relative to the market. Now, think of it as we all have real-time quotes or apps or charting systems that have a lot of red and green arrows. What I'm looking for is when we have down days or corrections with a lot of red arrows, I'm looking for the stocks that stick out like a sore thumb. I'm looking for the green within a sea of red, so to speak. So this all started, I started trading around 1997, 1998, and I did really well in Yahoo. Why? I don't know. It's probably dumb luck, but I wanted to go back and look at the technical characteristics of Yahoo before it went on to this tremendous 700% gain around the time I started trading it, went on to a huge gain in 15 months. So what I'm showing here on the top is a daily chart of Yahoo in the summer of 1998, overlaid with the market with a daily chart of the Nasdaq. Now, some people have asked me why to use the Nasdaq. To me, it's my go-to leading index. You can use the S&P. You can overlay it with any average for the most part. The point is to show you how a stock is holding up well relative to the market. So you can see when the market had its first correction in the summer around August, September of 98, Yahoo went into a correction. As soon as we had any tension relieved off of the market, Yahoo went to a new high. Now, on the right side with the second leg down, this was when summer of 98, we had a Russian debt crisis, long-term capital management blew up, and we had another deeper leg down in the markets. And you can see on the right-hand side, top right, that Yahoo barely budged. To me, how I interpret this, for those of you who have followed my videos for a while, you know I like to say the big institutions control the markets. These are the big pension funds, mutual funds that probably have deep, hardcore analysts that are saying this stock has a potential to be a big winner and to grow over the next 5 years or longer term. So they're not selling their shares. They're holding on to their shares. They might be forced to liquidate other shares, but they might dump the companies that they're, some of their weaker holdings. Or another thing is, keep in mind, the big institutions obviously don't only buy on up days. When there's liquidity on the down days, they might say, let's look to buy on the down days to support the stock, again, because they believe in it longer term. And from this point, when we came out of that correction, Yahoo went on to a 700% gain in 15 months. Now, there's a lot of people out there with different time frames. Some are day traders, some are swing traders, position, longer term holders. Whatever you are, the whole point is the beauty of this strategy is it works no matter what your time frame is. In other words, the market's giving you clues during a correction to show you what the strongest stocks are, and no matter what your time frame is, you at least have a universe or a basket of stocks that you could potentially trade. Think of it as a spring, like a coiled spring, meaning the market is keeping the spring down and keeping the tension down on these stocks. And as soon as the tension is relieved off the market, these stocks have the potential to go on to become very strong winners. Another example from 98 is Broadcom. It's a daily chart of Broadcom on the top, and you can see on the right-hand side when the market went on to make a lower low, Broadcom held up pretty well and didn't make that low. And you can see from the next slide, from that point, went on to a huge gain, 1,500% in 18 months. Now, some people will say this was the dot-com era, but I'm going to show you other examples of other eras where these types of powerful moves have happened. And once again, whether you're short-term, medium, or long-term trader, you had a great idea for idea generation to possibly trade or own this stock. Now, a few points about relative strength. A lot of people say, great, this is a great strategy. How do I find it? I know this sounds really stupid or simple, but just pay attention. Watch the tape. In other words, pay attention to when the market's going to a correction, you have a stock and you say, wow, the market just got killed here. This stock barely budged. A light bulb should go off that this stock is really, really strong. Embrace corrections. I used to hate corrections, but now I embrace them because the market's giving us clues. It's showing us, especially in deeper corrections, because the relative strength works whether we're in a few-day correction, a few week, few months, or a deeper bear market, but especially in the deeper corrections, the market gives us clues. That's why I always say don't argue with the market. Now, let's fast forward to some other examples throughout history. 2000. On top is a stock, Panera Bread. On the bottom is the dot-com collapse where the market dropped, I think it was like 35% in 17 days. That's a daily chart of the Nasdaq when the dot-com collapse happened. And I never heard of Panera Bread at the time. And I'm noticing this stock is on the new high list every single day. And the chart's split adjusted. But, you can see it's going, forget relative strength. This is making new highs. I called a friend of mine who's a trader. I said, you ever heard of this stock, Panera Bread? And he said, yeah, I'm short the stock. Why? I said, why are you short the stock? He says, well, because of the Atkins diet. At the time, I hadn't heard of it. I'm like, what's that? He says, oh, it's this new diet where people aren't going to be eating bread. And the Panera has the word bread in it, so I figure there's no way this company can work out because no one's going to be eating bread anymore. And I said, you're an idiot. That is the dumbest theory I've ever heard. And he says, no, I swear, this is the greatest diet. You can eat like 19 cheeseburgers a day. You just can't eat the bun, and it's the greatest thing ever. He had a heart attack towards the right side of this chart. I'm just kidding. But my point is, I said to him, why are you short a name where the market is getting crushed and all these stocks are blowing up? And forget holding up well, it is making new highs. From this point, and again, it's split adjusted. From this point, the stock went from 4 to over 150. It was eventually bought out, I think, around $320 by a private equity firm. But again, no matter what your time frame is, you could have short-term traded this or held it for longer term. But again, the market showed incredible clues and strength while we had that correction in 2000. Let's fast forward 2001, around September 11th. Obviously a horrible time. I remember it happened on a Tuesday. The market was closed until the following Monday. I want to go back real quick to this to show you the slide. The following Monday, when the market reopened, every single stock on my watch list, every single index was red. When I talk about the red and green arrows, there wasn't one thing that was green except one stock that was green, and that was Whole Foods. On September 11th, you can see the chart on the bottom. We gapped down when the market reopened, and this was the only stock. I think I had 50 to 70 stocks on my watch list and indices I was watching. It was the only one that was green. And sorry, I messed up the slides here. Let me go to the next one. And from this point, Whole Foods, the old symbol used to be WFMI, and it got bought out by Amazon. But the whole point is that from this point, it was during a recession and during a deep correction, the stock went up 400% in 4 years. Once again, going back to the definition, just to remind you, stocks showing strength relative to the market. Now, when I really started getting into trading and I was really embracing this strategy was 2003. So we had a 36-month bear market from roughly March of 2000 when the dot-com collapse happened. We went into a deeper recession after 9/11, and then we eventually bottomed around March of 2003. If you go back and do some work and look at some of these charts with Taser, with Cena, SanDisk, I remember went from 18 to 80 that summer. NetEase, Hansen, which is now Monster Energy, one of the biggest winners of the last decade in the Nasdaq. If you go back and look at these charts, it's a very, very similar pattern where the market went into a deep, deep bear market correction, and these things just held up incredibly well and went on to become tremendous winners. Now, I always tweet about and talk about pay attention to the leaders. You want to pay attention to leading stocks. And people say, well, how do you define the leaders? One way I define it is leaders tend to make new highs as the market bottoms, sometimes on the exact same day or within a few days of a market bottom. That's why one strategy is to watch the new high list for idea generation. I showed you 98, 2000. Let's fast forward to 2009, the financial crisis, housing collapse in the bottom, March of '09, when we bottomed, coming out of that financial crisis from the '08, '09 bear market. Netflix held up like a champ, and right around when we bottomed, you can see in the top, I'm overlaying Netflix with a daily chart of the markets. You can see Netflix went on to make a new high right around that time when we bottomed, and you can see from here, from that point, it went up, and the chart isn't updated because it's obviously gone up more and split, I think, whatever it was, 7-for-1 or something. But so it's probably up over 2,000% since that low. However, I'm just showing you that it showed incredible strength, and no matter what your time frame is, you could have traded this for a tremendous gain. Now, quick trivia question for you. Coming out of the financial crisis, what was the first stock to make an all-time high coming out of the crisis? Now, think about it for a second. Financials, energy, housing stocks were all down 60 to 90%. Not the first stock to make a 52-week high, but to make an all-time high. If you need to pause this video to think about it, I'll give you one hint. It's coffee related. And that chart is Green Mountain Coffee. Same thing. On the bottom, we have the financial crisis. Green Mountain Coffee, within a day or two of the lows, made a new high and was the first stock to make an all-time high, and that was incredible relative strength with just great power. Again, the slide's not updated, and I think it went up more than 1,100%. Eventually got bought out by a private equity firm. Realizing a lot of these stocks get bought out. I don't know if that's coincidence or whatever, but it got bought out by a private equity firm. But once again, the market showed incredible strength. Now, I want to touch upon the opposite of this, which I call relative weakness, or the reverse of relative strength. I remember with this example, Myriad Genetics, MYGN, that's the chart at the top. I remember trading this around the March of 2009 bottom. You can see it broke out right around, towards the end of March and made a new high, bought it around 40, immediately went to 44, and I'm thinking, I've nailed this, is going to be a big winner because this thing is one of the first stocks to emerge to a new high. Something very interesting happened. You can see the market kept, as it bottomed, it kept going higher and getting stronger and stronger, and this thing kept getting weaker and broke its 50-day, and eventually I stopped myself out because I said to myself, wow, the market's strong, and this is not even this isn't even participating. And from that point, Myriad Genetics went down over 56% from when it started to break down. That's why I added this last point to leaders. Again, just to review, leaders tend to make highs as the market bottoms, sometimes within a day or a few days. Watch the new high list. However, you still have to use stops. This is not automatic. What I mean by that is there still has to be risk management around this. We are using this strategy, or I use this strategy to help my probabilities of finding a stock that has potential to go up, but it's never automatic. There always has to be some sort of risk management around this. Fast forward to some more examples throughout history. May 2010, we had the flash crash. And I remember, you can see at the bottom is when we had that ugly flash crash. Spreadtrum Communications, another one that got bought out, by the way, totally random. But similar to Panera Bread, the market's getting killed. A lot of stocks were getting cut in half on the flash crash, and Spreadtrum was making new highs. Now, look at what happened. We had a correction that summer, and a base was formed. That's what a base is, a cup with handle, double bottom. What is a base? It is basically buying time while the market is going through a correction. So bases are formed during market corrections. It's almost as if the stock really wants to go higher, and it's sitting there saying, okay, Mr. Market, whenever you're done, correcting, I'm ready to go higher. Now, notice something on the bottom right-hand corner of this chart. That is September 1st, where the market bottomed. We had a follow-through day. Ben Bernanke announced QE2 at Jackson Hole. And look at the top right of this chart. Spreadtrum breaks out of a cup with handle on huge volume. Again, as the market bottomed on the exact same day, this stock went to a new high. And from that point, you had 120% gain in a very, very short period of time. Acme Packet, I think Cisco bought this out. I'm just laughing because I'm just realizing as I'm doing this, a lot of these got bought out. Same thing. every time a little tension was relieved off the markets, it wanted to go higher. Then we had a couple days down, and then it just held there. And then we had a little relief while we're correcting during the summer. It went to a new high, actually formed an ascending base, meaning that every single time we had a little dip, it held in there, and a little tension relieved off, it went higher. Now look at this exact same thing on the right-hand side of the chart. When we bottomed on September 1, it went on to make a new high the day the market bottomed and went up over 100% in just 5 months. Now, I'll leave you with one other example. It's a little more recent, February of 2018. When you look at the bottom there, I used the Nasdaq, but at the time the S&P was the first time in history up until March of 2020. Sorry, but it was the first time the market went from an all-time high to greater than 10% correction in less than 10 days. Everything was getting killed. The markets got hit pretty hard, and Coupa Software, COUP, was on my list around $36, $38, did not even budge. The market had a very sharp correction, and this thing didn't even budge. As soon as we bottomed and had a tension relieved off the markets around $36, $38, it went on to, I said 100% gain, ended up going to over $150 in a couple of years. So my point is, again, relative to the market, it was a stock showing incredible strength. Now, a lot of people love this strategy. They say, what are some ways to help with this? I know it sounds simple and stupid. Just pay attention. Pay attention to when the market is weak, to the stocks that are holding up well. Check out the new high list, especially on down days and around market bottoms, and use some screening tools. A lot of times in my videos, I use MarketSmith, as you know, to screen, but there's free ones with FinViz, Telechart, and you can always Yahoo or Google. Yahoo Finance, I think, has one, or just Google screening software to look and go through charts for the stocks that are holding up well. I hope you found this video helpful. If you are looking for examples, which is what I do in my educational product, because as we're going through a correction now, if you're looking through for examples, I do a lot of the work for you. I recommend doing the work on your own, but if it's something that you need help with, or don't have the time to do the work, I'm presenting a lot of these type of ideas besides the educational content when I do twice a week videos explaining some of the stocks when we're going through corrections that are holding up well. So if you have any questions, you can email me, jfahmy@soarcapital.com. If you are interested in the product, you can check it out at joefahmy.com/investor education. Thank you for the time allowing me to present this. I hope you found this helpful, and good luck with your trading.